Do you trust your crypto assets to centralized exchanges that actively sell your private information and front run your trades? Would you like to buy and sell your assets without any middlemen, intermediaries, or robots? Do you like paying slippage, fees, and having the price go up as bots steal from you on low liquidity decentralized exchanges? The solution is Nodemarket.io. Set your guaranteed buy or sell price. No middlemen, no slippage, no bots ever. Buy or sell 1, 10, or even 10 million tokens, and you never have to worry. OTC trades are between you and the seller or buyer, guaranteed by audited smart contracts and no human middlemen. Nodemarket.io. What is hypercycle? Hypercycle enables AI systems to communicate and collaborate efficiently. Currently, this process is slow and costly. Hypercycle improves this by offering a secure global connection system with verifiable identities without depending on centralized parties. It provides a safe platform for AI to interact directly without intermediaries. For more information, go to hypercycle.ai.
All right. Looks like I got through them all. Woo! All right. If you have any questions, let's knock those out. And then we're going to get into some game theory stuff. Man, did you guys see? Holy crap, all those upgrades to GPT-4. So badass. Basically, GPT-4 Plus, which is fast AF and a huge context window. The context window went from 8K to, I think, 128, something like that. Something so ridiculous. Basically, 300 pages of word text, like 300 pages, like 100,000 something words, like ridiculous. So you can take pretty much a whole novel and throw it in there. Any white paper, like any white paper at all, you can put the entire white paper in there, and then you can communicate with the white paper. And you can create basically GPTs, which are fine-tuned transformer networks just for you, where you put in a bunch of defaults, presets, any information you want to have in the background. For instance, someone who was clever, like Ken perhaps, would build a GPT that's got the 5 T's, the rules for taking profit, 10x, take 22x, take 10, all of the basic. We could build a digital investor GPT that would be fine-tuned and specific for looking at team, timing, technology, tokenomics, why does the token exist, like all of this stuff. And then you could have a dedicated, basically, not just an AI assistant, but like a whole transformer network specifically for that. Me and Brandon will kind of mess with that. But yeah, it's pretty badass. But so they expanded the context window. They're doing a whole bunch of stuff. And then there's a bunch of API stuff for developers. Because yesterday was the developers conference anyway. It's pretty badass. Yeah. So there you go. So on the for those of you that are curious on the NFTs, let me just pull this banner. The number was 1166. I think that was the number last night. Let me look in the mints. 2 hours ago. Yeah, 11. So it was 1166. That's the cutoff for the 50% rev share. Everybody else will still get 21% or more. If we were to hit 2,000, they would get 22% or whatever. Anyway, there you go. Great. What else was there that we need to talk about? I would go look at the information that came out of the developer conference yesterday. It was pretty badass. A lot of cool stuff. And basically you're just seeing one company after a next disappear. Anybody that's building a feature that utilizes GPT, if the feature becomes, look, if your company, you got to decide if your company is a feature or if what you do is as a human is a feature. Because if what you do can be replaced by a button on GPT-4 or 4 Pro or 4 Turbo or 5, you're already fired, bro. You already don't exist. You are already a useless cog in a machine that doesn't need cogs. In a digital watch that doesn't need gears, you are a gear. Like, it is what it is. You're going to have to just absorb it. Anyway, why it's even that much more important to be a competent investor, a competent fiduciary. So today we're going to talk about game theory-based investment strategies, long-term versus short-term, and a little bit more in-depth maybe than the last time. So I'm going to make sure that we leave a pretty good chunk of time for that. But we will cover some questions because it is office hours, ergo. We're going to have our office hours. So let me see. I'm going to make sure I knock out all the ones that I did not get to. Will there be a GPT on Singularity Net? Okay, so Conan, it would be GPT, General Pre-trained Transformer Network. I'm sure that Singularity Net will leverage a variety of large multimodal models. And multimodal means not just text to speech, but text to video, text to art, speech to text, speech to ... At some point, it's going to go thought to ... And at some point, it's going to go precog to ... where it will know what you need done based on your patterns and history and all that. And it will just present it to you when it's time to give it to you. Like, it's easy to extrapolate this forward and see how many people are going to get obviated out of the job force. It's also easy to see which companies probably won't exist. Remember, like at the beginning of the year, there were all these dumb companies like, we make your text into audio. No shit. Everybody's going to do that on every single platform they want. That'll be super easy, basic, rookie ass stuff. All of this stuff. And look, anything, if there's a company that's building something, because you're going to get a lot of people approaching you with stupid ass AI ideas. Oh, this is going to be amazing. This is a new AI company. No, it's not. You're using GPT-4 in the background and you're just putting some spammy shit in front of people and trying to collect money. Most of the companies that are building in AI are just spammy bullshit companies using ChatGPT in the background, and they're not doing anything interesting. And if it is interesting, then OpenAI will just offer it as a service, or Google will just offer it as a service. Google's Gemini is coming out pretty soon. So we'll see that Gemini starting to compete with Google, Meta starting to compete. With I think Lambda is theirs. But anyway, and then you'll see systems that utilize all of these in the background and then might do more specific things. But I would just be careful. Be careful where you're investing, that it's not just a button that someone can click. There needs to be something unique, or there needs to be unique individuals on the team that are not reproducible. That's why I like things with like Tufi Saliba and Ben Gortzel and Dan Tolliver and that team, like, because those humans, yet at least right now, are not reproducible. Once we pass the line of like AGI, well, then we don't know. We don't know what we don't know. Yeah, the GPT store. So that's another cool thing. If you come up with a GPT that's super badass, you will be able to put it in the store. Other people will be able to use it, and you get paid a royalty on it. So if you come up with something specifically unique and interesting that might have some proprietary data or something like that. Who knows? Something that you've collected over a lifetime of effort, or whatever, even 17 minutes of effort, but something that you know, or something relatively proprietary, not publicly available, that you have, that you're willing to feed into building your GPT. You can then put that in the GPT store, and if people use it, you get paid. Get paid, bro. So I don't know. It might be cool to have like a competent investor GPT, but what we're likely to do is we're just going to have a digital twin and have GPTs plugged into the background so that all of the math, well, when they get the math right, that's one thing that these multimodal systems don't quite have 100% of the time, and that's the math. But if you ask it to do the steps, the math is correct. It's very weird. And then you say, hey, are you sure you got that right? Can you do those steps over? And it'll go, oh, crap. Yeah, okay. And so we're not there yet, but that's good, because if we're not there yet, that means there's a lot of opportunity. Marriage. It's not for me, but for a lot of people, it makes sense. If you mean the marriage of the hypercycle tokens, so technically at the 512 node license level, meaning the master node, you can do that right now. You can marry tokens to licenses. The problem is, there's a lot of people that just think they're going to pledge licenses with no tokens, and there's only so many tokens. I mean, think about it. A lot of the tokens haven't been released yet because there's an emanation. There's a release schedule for the tokens. Okay, so that's one thing. Two, a lot of you have tokens. You're going to put them in your node licenses. So that doesn't leave available tokens. There's only so many tokens that can get lent to HyperPG because there's only so many tokens. So as people start marrying those tokens, I'm telling you, there's going to be a goddamn rush on this token, and everybody's going to be like, oh man, those guys are talking about it for a month. Yeah, it's obvious. It's beyond flipping obvious. Get your tokens for your node licenses, or potentially you're going to try to pledge them, and they won't be able to fill them. They're going to fill their own licenses before they fill yours. Like, come on, man. But anyway, we can break the token, the licenses down from bundles to the individuals right now. We can do it. We have the technology. But if you don't have the 1155 token, the hyper share token of the marriage, right? That part, I think they're still waiting for some audits. And the problem with the audit process is you don't have any control over it. It's the auditing firms. That's it. You're at their mercy. So when those pop, then you will be able to marry. And I think that could be days or a week or so, not very long. But here's the caveat. If you don't have hardware to run them on, and you break your bundle, you break your node licenses off. Let's say you have an 8-pack. You break them off. You put tokens in them. Yes, they're married. You get your hypershare token. Awesome. Everything's great, except you're no longer tilling. So your reputation's going to go away. So for now, it doesn't make sense to break them apart until the entire chain of events can be applied to your tokens and licenses. Don't do anything. The only thing you should be doing really is getting tokens now before you look at the price, and they are a lot different because everybody's trying to get tokens because they've all wised up to the reality that there's only so many tokens. It's so beyond obvious. Is there a word that's beyond obvious? Can someone give that a Google? Anyway, what's up, Jimbo? All right, so can ChatGPT do what Twin wants to do? Well, Twin is very specific. It's a business-to-business play. It's kind of an HR play. And ChatGPT can do background things like provide you information and things like that. What it can't do is manage your personal digital identity. And so I think that's what Twin is endeavoring to do, is manage personal identities. And that's different. So whether that's a business protecting IP, whether that's you protecting your own IP and your digital representation, and then being able to copy and send that out. a lot of the, plumbing for doing that is going to be built with AI systems that can code and all that. But what Twin is doing is very specific. And then there's a lot of relationship management. So I don't think it's quite so simple. I do think that the constant progression in like GPT and Gemini makes it where your Twin will be as capable as the best GPT systems, but have all of your personal nuance. Does that make sense? So the more you build it out, the more it becomes you. And that digital representation of you at some point can function as you, or an ancillary to you, or an assistant to you. I think that's where a lot of value is. So that's what I'm saying. Plus, we're going to be in a bull market, and that token's going to rock. Do you think Meta, Microsoft, Google will use hypercycle? I don't know. It's hard to say. I mean, it's kind of like saying, do you think a company would use a cheaper, more effective cell phone plan, or like global communication plan or internet plan? Yeah, if they can save money, they'll go where they can save money. And remember, you don't need a big market penetration for hypercycle to be just impossibly successful. They're not trying to take over the world. They're just trying to take over one little bitty bit, little tiny little morsel. Let's see. Question: what is so novel about Twin that will make it unique and not easily replicated value? I think we just talked about it. Yeah. What's valuable is you. You are valuable. That's the benefit. It's the you that they can't reproduce or recreate. It's the same. This is all the crap that all the Hollywood people are striking about. They're just doing the wrong thing. They're just looking at the money. I want more money for this. I want more money for that. Because they're a bunch of greedy pieces of shit, if we're being honest. I get $16,000 a week. I deserve $18,000. You don't deserve shit. You worked 3 weeks. Nothing you did contributed to that show. These writers are ridiculous. They're so bad. When's the last time you saw anything that didn't suck? Really? When's the last time you saw a show that didn't suck? There's a lot of money that goes into all those shows that suck that we pay for one way or another. Just a lot of suck. And so when these people are like, I don't want AI to do my job. Well, you're not doing your goddamn job. So what's the difference? All you're doing is making a bunch of crap that sucks. Ugh. TV's bad, man. Anyway, the value to Twin, well, there's a bunch of different things that I like about it. But one is you creating your own digital you that you have full right and provenance over. That alone to me is valuable. And then no matter where it's used, they got to pay you a piece, unless you want to do it for the sake of humanity and, give out the greenfield rig to whoever wants to use it. But the Nick Black rig is going to cost you money unless you're a digital private client or a digital investor, in which case you will have access to it. But don't leverage it for decisions, financial decisions. It's just for entertainment purposes only until we get really good with it. Right now, we're uploading all of the office hours content, all of the shows that we've done, going all the way back as far as we have, like a few thousand hours of content, to see how good the responses are. So anyway, fun stuff. Okay. Hypercycle on the shortage run. Yeah, there's going to be a shortage run on Hypercycle. I think that's going to be this year, not next year. And then there's going to be another run on it before compute starts. Oh, you'll see. You'll all see. You'll all see. What token do we have? We're staking on SDAO. What do you mean? There's a lot of tokens that you can stake on Singularity DAO. You just need to go to Singularity DAO and check that out. Bump. Okay. Let's see. If Hyperpool pays 32% to the nodes that are married to the tokens, what would a node with its tokens married get from HyperPG? That's 12% and 20% added together at Hyperpool, and that's of the revenue that's generated. HyperPG is just paying a fixed return. HyperPG is like buying a bond, essentially. Like they're paying you a return. You're pledging. It's kind of like repo. You're pledging your assets. You're getting paid a return. And then at the end, they give you your stuff back. Hence, repo market. Hyperpool is a rev share. They're taking your assets, they're putting them into play, and they're taking all the money that comes and they're distributing it out. Yeah. Yeah, that's another thing. A twin, Sam, that's a good point. I think it would be cool for a lot of people to develop a twin to hand off whatever to their kids, to their grandkids, to their progeny. Might be cool for centuries to be able to talk to your great, great, great grandfather that was like a particle physicist or like a super criminal. Anyway, whatever, any of those things. Both, maybe both. Yeah. Okay. Yeah, Hollywood's terrible, man. It's all crap, and it's just retreading crap. I know some writers; they're the biggest hacks. They are the most self-important assholes you will ever meet on the planet. This douchebag. I know this douchebag who every show he's written for, the show has crashed, and they just keep promoting him. He's terrible. He's a nice guy though. People like to work with nice people, even if they suck at the job, and that's the problem. It's not a meritocracy in Hollywood. It's just a homeboy, nepotistic, bullshitty mess. If you don't know someone and kiss their ass, you got nothing coming. It is what it is. I don't have any delusions about being part of the Hollywood system, so I don't give a shit. Otherwise, I'd probably be burning all sorts of bridges. It's a spammy kiss asshole network. And yeah. And also, if we're also being honest, people have been treated really bad, especially at the executive ranks, for a long time. Like, I'm not getting on the whole woke thing, but there is a lot of egregious behavior that's been going on for years. And a lot of these corporate douchebags are finally starting to get weeded out. That's the one good thing about strikes. All the bad deals, one-hit wonders, bullshit executives, they all get purged. Not all of them, but most of them get purged when these strikes happen. So that's a good thing. Let's see. Hypercycle, is it Ethereum 1150? No. Hypercycle found. You're going to have to go back and do a bunch of research. You're not going to figure out Hypercycle. You're not going to learn the whole system today in the chat. You have a lot of work to do. Go back and watch every single This Week in Hypercycle. Go to this Hypercycle chat on Telegram. Make sure it's the real one. You need to go read the white paper or take the white paper, put it, copy it, paste it into GPT-4 or Claude 2 and talk to it. Ask questions and all that. One question at a time, you're never going to figure out. You're not going to figure it out. I'll be honest. And that probably means slow down. And that probably means you don't need to be owning any of it. If we're being completely honest. When I look at the NFT, it looks like history in the making. I'm sure some of the big boys are looking at whose faces are on there. Oh, that's funny. Does Hyperpool split like HyperPG? Okay, all nodes in production, Joseph, they start at basically a threshold of 1, and I'm going to be very simple here. It uses a combination of your uptime, okay, your compute, like the compute prowess of the hardware you're on. So compute plus uptime plus total reputation. And each of these is like 1.26 times 1.26 times 1.26. When those numbers accumulate over time, because you're doing more work, because you have good uptime, because you're building this reputation, you get to a threshold of 2, the node splits automatically. Your node license splits when it hits 2, no matter what. You don't have to do anything. It's when it gets there. When it gets there is determined by the efficiency of your equipment, right? How good is your hardware? Your uptime. Are you always beaconing to the network that you're available, right? And then your otherwise your reputation for good completed compute work and things like that, and AI tasks and such. So if you are a participant, a real-time participant in the ecosystem as far as compute goes, between 6 and 18 months, your nodes will split. The 6 month is like the fastest it could happen, but like the 18-month is like the basically the slowest it would happen if you had consistent uptime. If you unplug, obviously you go backwards because you're not part of the network. So you go. Creating a twin could do away with inheritance taxes instead of passing. Oh, that'd be interesting. Oh, yeah. Maybe you create a really good twin of course, you'd need some kind of input mechanism for new data and new law. But if you had a really good twin, it could continue managing your money if it got really, really good. I don't know. That'd be scary. But again, like if you were going to, well, then what you would do is do like some kind of brain upload, which who knows, when we get to AGI here in a year or 2 or 3, you probably will be able to do like just an upload. Like, that'd be badass. We're all out of a job. Jesus. Speaking of bonds, I heard the big banks are taking a big hit on unrealized bond losses. Yes. Yep. That's going to be a theme, I think, that comes up more. I mean, that's part of what these unrealized losses and stuff is what sunk Silicon Valley Bank and Silvergate and all this. I mean, they just shut their asses down. These other banks have these losses. The FDIC doesn't do anything. Why? Because they can't afford to bail out big banks. That'd have to be government coming in to do that. So all these banks are taking these big hits. Oh, and then weird that Jamie Dimon just a few weeks ago said, I'm going to sell like 10% of my shares for tax reasons. For tax reasons, I'm just going to sell 10% of my JPM shares. And then this came out. Oh, weird. It's almost like he knew, isn't it? Isn't that weird? It's almost like he knew. It's weird that we didn't know, but that he did. JP, these guys are so scammy. Twin Nick will tell history how Nick made some. Yeah, hopefully it won't be like then Nick built a spaceship and the spaceship got atomized on the launch pad. Like, shit. I'm not going to go up in spaceship number 1 to the cloud city. I'm going to wait like 5 or 6 versions. Then I'm going to go. Yeah, NewNet's doing good. I don't want to get into price discussion too much, but NewNet has been doing quite well. Denny asks, do you know when is the next scheduled release of hypercycle tokens? Well, they're releasing all the time. I mean, starting tomorrow, because May 8th. So June, July, August, September, October, November. That's when the normal token distributions would start for early investors, launchpad people, and all that kind of stuff. So I would imagine a fair amount of tokens are going to be coming onto the market. On the other side of it, there is a need for tokens. A lot of people don't have the tokens they need to marry into node licenses. So I think those things will probably just kind of wash each other out. And I think that for institutional investors coming in, it's very difficult to get big chunks of tokens. So you actually hope that a bunch of people start listing. Like I always go here and I see who's listing tokens, go to the exchange, and I'll just go to recent listings. And you see a few, okay, so about an hour ago, 3 hours ago, so you see 2,000, 2,000, 2,000, 6,000. It's not a lot of tokens. What we need to start seeing, because the DEXs are no better, you can't get any tokens. We need to start seeing 10,000, 10,000, 10,000, 20,000, 50,000. We need to see big numbers of tokens being made available so that people can fill nodes and bundles and master nodes, right? So like we've already, just through like Nodemarket and our associates have sold like 50 master nodes. So that's 50 times 524,288 tokens. So that's already a need for more than 25, 26 million tokens. You're not going to get there 2,000 at a time. You're going to need a little bit more than that. Anyway, yeah, they always bury the lead. But I saw that article when did I see that article? That article was out like last week, right? Or maybe Saturday. And you just never heard a thing. They're just so sketch. $40 billion. Now that's unrealized bond losses. That's a differential between like if you had to sell those. Because remember, as yields go up, those bonds, the prices of those bonds go down. It's an inverse proportionate relationship. And you can think of it like this. If I don't want to buy a bond, if I'd rather be somewhere else in some other market, they have to incentivize that. Incentivizing means the yield comes up. That bond is now worth less. They have to incentivize it more. So the yield goes up. So you say, I'm not buying that crappy government debt at 2% that pays 2%. What if it paid 3%? Maybe. What if it paid 4%? Okay, I'm listening. What if it paid 5%? Okay, what if it paid 6? Hell yeah, it doesn't pay 6. But what if it did? Oh, well, then it'd be a junk bond. Ah, shit, U.S. government debt is a junk bond. Oh, never mind. Don't talk that way. But that's how that inverse proportionate relationship works. And that's the way you need to look at it. Look at bond prices and their relationship to yield as the after effect of behavior, not what elicits behavior. You say, okay, if I see yields going up, that means bonds are less interesting. People are getting out of bonds, and that yields going up as a mechanism to incentivize people to come in. So when yields are going up, the bond market's getting gutted, right? And B of A got their ass kicked too. It's very weird that none of this stuff, it seems like a big deal. And then, when you have a maturity mismatch at a bank that has some relationship to crypto assets, oh, we got to bail them out. We've got to shut them down. Why? A lot of what the FDIC did is borderline illegal. Borderline. They skated on the edge. But whatever, they can do whatever they want because they is they. What did Clinton say? It depends on what the definition of is. All right. Yeah, that's right. It won't matter. They won't realize those losses because that's a good point too, is that they won't ever have to be forced to sell because the bigger banks would always have infusions of capital from directly from the government if they needed it. So they're just kind of marking to market also. But maybe the greater story is that no losses sustained by the government or otherwise will ever be realized because they'll continue to flood it with currency units that they create into existence either through lending or actual debt financing. So there you go. It is what it is. All right, let's switch gears. We got to get into our brain space, and we got to talk about. Well, first of all, let's get some cool game theory. Is that game theory music? What's our game theory? Yeah, that sounds more gamey. It's more game theory-y kind of stuff. So we're going to talk about game theory-based investment strategies. This will be fun. You're like, no, that doesn't sound fun. Yes, it will be fun. You'll see. Oh, wait. Do I have a cool picture for that? Let me think. I think I do. Hold on. Panic. Did I do a panic? Oh, I know I did. I'm almost certain I did a cool picture because I was thinking I need a picture that looks like a whole bunch of panic on a trading floor. Oh, not only did I, but did I? That looks panicky. Okay, let's use that one because it's got monkeys on it and I love monkeys. Okay, I'm going to write monkey. You'll see. This will all make sense. But for now, let's do this.
Hello. You're late.
Oh, why did I not do it? Let's go. Ready?
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
Yeah. So again, GPT-4 using DALL-E 3. So as we're kind of thinking about this, again, put on your game theory hats because there's a lot. This is a rich subject. And essentially, we want to talk about game theory as it relates to short-term, long-term, meme trading, and trend trading versus the much longer idea of kind of value investing. So essentially, we're going to go over most of those terms. We're going to do an overview of kind of game theory involved in these different strategies. I'm going to give you a little bit of fundamental concept of game theory. I'm going to talk a little bit about how you would apply the game theory to, I apply game theory to everything, but not all of you will, at least not yet. But if there was any one fundamental system for thinking, it's game theory. And so we kind of need to, I guess I'm going to continue to hit you over the head with this because it's so important. And then real quick, let me see. 10% efficiency loss with the split. No, I'm not going to go into all that stuff. Let's switch gears from hypercycle. You can, all these hypercycle questions, honestly, you're better off asking them in the hypercycle chat. Right? Does that make sense? Okay, cool. Great. Yay. All right. Today we're going to delve into the intersection of behavioral economics, finance, economic evolution, mathematics, and the game theory behind the basic different investment strategies that you guys are going to see, especially in the crypto space. We're going to contrast this kind of what is it, the allure of short-term profits, which, you know, a lot of times get driven by meme coins and this kind of ebb and flow of trendy bullshit that you see on Twitter. Sorry, X. No, it's Twitter. And versus the more steadfast approach of long-term value investing. Like, there's a reason why Warren Buffett and Charlie Munger are old dinosaurs and they have $157 billion in cash. They've done okay, right? And so you can't just discount, even though they're not big fans of tech, although their biggest position is Apple. They say, well, we're not in tech. Okay, but Apple. But anyway, they get it and they've gotten it for a long time. And the fundamental math underneath all of this is game theory. And this is a field that won John Nash. Remember the movie A Beautiful Mind? Anyway, he won the Nobel Prize, John Nash. And this allows us a kind of framework or a modeling so that we can anticipate the outcomes of the strategic interactions among players in a game. Thinking like, if you look at a system of people or participants, you say, okay, rational decision makers, unlike the monkeys you see in front of you. But the cool thing is, you say, well, rational decision makers. People can arrive at a rational decision. Doesn't mean they're rational in the moment. Most people are not. This is what gives you an advantage, especially a time advantage on other investors. And the you that doesn't think about game theory versus the you that does, wins. Is anybody here in the chat that has been with us for a while, maybe implementing some of this stuff for the last couple of years? I know that in just the digital private clients, like since May, we have like 23 people that have made like booked $1 million or more. So that's pretty cool. Anyway, but there's other people that have done really good that have been starting to implement this game theory for a while, game theory and cognitive bias. So that's why I keep preaching it, because it's the thing that helped me kind of break free of basic kind of investment stress. How do I come up with the next idea? How do I beat this group? How do I out invest and all this kind of stuff? And that's just the wrong framework. You think about thinking. You think about the decision-making process. And that's game theory. And so the idea is, how do we maximize our own payoffs in a market that's full of people, lots of people, right? People that we assume are rational decision makers. And for the purposes of what we're doing, we assume everybody's a rational decision maker. People that are not rational, you can't ever imagine what they're going to do because they're irrational. Sometimes they'll behave rationally, accidentally. Sometimes they won't. So you don't care. You just write it off. You have to just reduce the noise. And as we go into this, what I think is going to be a big bull market, you're going to see a lot of noise, a shitload of noise from CNBC, CNN, BB, like noise from your friends, your grandma, your uncle. Everybody's going to know everything. When the markets are going up, every asshole that made 3% thinks that they're a hedge fund manager. You're going to see a lot of bad hedge fund managers looking good because everything goes up. The Michael Saylors. Look, I told you I was right. Bullshit, bro. Tax evading piece of shit. This dude has been wrong for 2 years straight. Now he's right for 3 days and he's suddenly a guru again. He's red-faced assholes all over, the media. I told you. Like, come on, bro. Everybody's going to look like that. The Mike Novagrats, all the douchebags are going to come right back. All of them. And they're going to tell you, I told you so. And you got to just reduce all the noise. So this is where kind of like that realm of meme investing comes in. And this is typified by this sudden rise and fall of stocks, SPACs, bullshitty crypto stuff that's promoted mostly through social media. And it's going to give you this high stakes, rapid pay, huge increase in capital. Like, you're going to get rich. This is the way to do it. Kind of that whole mentality, like, I got to act now. No. Yeah, that's right. So you can get tips from your Uber driver, Uber and Lyft drivers, right? Yeah, no. Like, I don't care what the excuse is. Like, no, don't. Even if it's Brad Garlinghouse pretending to be an Uber driver, especially if it's Brad Garlinghouse pretending to be an Uber driver. But the essence of this meme stuff is it creates this pulse of the modern culture. And it's like, well, if you're not part of it, you're going to lose. But it doesn't hold up to the scrutiny of game theory. And so that's why you have to have this lens. So if you think about value investing, which we do, is much more longer, it's longer term. I mean, as long as, 3 years is long term these days, but it's a strategy that is championed by people like Warren Buffett, by, there's a handful of fund managers that I kind of follow. I do listen to Warren Buffett, Charlie Munger, but I don't really follow what they do in their portfolios, but I like where their heads are at. Jeffrey Gundlach is one of my favorites. So there are a handful of really competent fiduciaries. You've got to find who works for you, but I do like, there is something to be learned from learning about people that have made massive amounts of money by managing money and just looking at their strategies. But most all of them are, other than these flash in the pan dudes that just come and go, it's a long form game where the players' strategies unfold over years and the payoffs are reaped in the form of compound interest and intrinsic growth of underlying assets. And the way we look at that, that's our 5 T's, right? That's another way for us to maybe delineate beyond the pile of potential investments what's going to be a little bit more to our personal liking. You need some system. You don't have to use the 5 T's. You can do whatever you want. For me, I use the 5 T's, and then I say, okay, can this project or token achieve use, utility, and wide-scale adoption? So that's the lens, but it's all on top of game theory, right? It's all, the math is game theory. So as we unpack the strategies through this game theory binoculars that we use, we need to explore how a rational decision maker is going to make decisions and the consequences of those decisions on the individual wealth, and also like the market health, like where we are in the market. And this tells us more about human behavior, market efficiency, and then we're at the beauty pageant again. So yeah, but John, remember that's 17 days, and he's correct. Bull markets have 17 big days, but that's 17 big days. Those are the biggest days in a year. It might be 17 days in a year. We haven't seen any of those days yet. In the last 2 years, we've maybe seen 1 or 2 of those days at the beginning of this year. So I would strap in. Anyway, so first let's look at the foundation of our decision-making process with the game theory key concepts that we all need as we move forward. So game theory, basics. In the realm of economic science, actually, I mean, game theory applies to like a lot of behavioral psychology, behavioral science, evolution. But for us, we're in the economic space as investors. This is the mirror that we use to reflect the strategy of SIPG, the strategic interaction between players in a game. Sometimes they're competing, sometimes they cooperate. But it is the study of mathematical models of conflict and cooperation between intelligent and assumptively, because it's all assumption, rational decision makers. And why do I say rational about 45 times? Because game theory assumes that all players that we're competing with or that we're studying are aiming to maximize their utility, to maximize their payoffs, right? And this is a term that economists and, Nobel laureates will use to describe satisfaction or returns, right? So we want to, in game theory, we want to see what would these individuals do to maximize their own utility or their own payoffs? How do I maximize payoffs? Like, can I do a thing? What's in it for me, right? So the foundation of game theory lies in understanding that players' payoffs are independent for the players, but they are interdependent in a system where there's rules. What does Charlie Munger always say? Like, you show me the incentives, I'll show you the outcomes. Everybody is incentivized in a system with rules, based on the rules, based on the, there's certain strategies, and your strategy might lead to a higher payoff if others do what you expect them to do, or vice versa. And the natural culmination of that is that everybody's going to do what's best for them, but based on what everybody else is going to do that's best for them. So, and this is particularly important in investing because sometimes people arrive late to a conclusion. We're all counting on that. We're counting on the idea that we arrive early and that they arrive late. They may become more rational with more time, right? So an individual's actions can be profitable if they align with or anticipate the actions of those around them, right? So if we anticipate these things sooner, then we're actually taking profit as other people are entering positions. It doesn't mean that they can't also win. It means we win a lot easier. And that's the thing. We win easier because this makes you statistically more likely to be first, or at least in the early bunch, or at least competent in and around the space that you're investing. So one of the simplest the simplest model in game theory, and you hear this all the time, we talk about a lot, is the prisoner's dilemma, right? And that's a game where it shows how two individuals might not cooperate, even if it seems like it's in their best interest to cooperate, right? Like, they both got captured. Keep your mouth shut. We won't do any time. But if you talk, you're gonna get off with a year, but I'm gonna do 5 years. If I talk, I'm gonna get out with a year, but you're gonna do 5 years. So what happens? Instead of keeping their mouth shut and doing no time, they both talk. And even though, that's not cooperating, they've still done what's in both of their best interest. That is the Nash equilibrium. They can't do any better with any other decision. So they've reached kind of an equilibrium. Anyway, this is the prisoner's dilemma, shows how sometimes human behavior, it's obvious, but only after you think about it. It's not immediately obvious. And so when you translate to the market, even if all of the investors would benefit from stability, for instance, if everybody that owned Hypercycle simply priced it, they weren't willing to sell it for less than $10, then guess what? Hypercycle would be $10 a token. If everybody, we see the prisoner's dilemma in markets in real time all the time. If everybody just priced their tokens at 10, the price would be 10. But that's not the reality, is it? And so even if all investors would benefit from a kind of stability, the temptation for individual individual kind of personal gain leads people to make other suboptimal decisions, right? Like, oh man, everybody's got it for 10. If I put it for 9, everybody's going to buy my tokens, and I can, what if I put it for 8, then the dude that listed it for 9, they'll grab mine and you see where this goes. And it falls to some other equilibrium where people are like, I'm not willing to sell it for less than that. That's period. That's it. I'll just hold it. And that ends up being the market floor, right? And so again, people behave on the aggregate suboptimally. And that's also something you can invest against. So one of the other, this key concept we talked about a second ago is Nash equilibrium. And you hear this a lot. It's named after John Nash, who kind of championed game theory. This is a situation where no one player or participant can benefit by changing their strategy while the other players keep theirs unchanged. And it creates a steady state of any scenario where all players are kind of in accord. And in a market, it means that prices reflect all known information. Now, there's also the efficient market hypothesis that says that all information is factored in all the time and all this. I don't agree with that, because all the time we're finding out that people know stuff that other people don't. But I do think in the crypto space, we have the closest thing to the efficient market hypothesis, the information theory, where we do have a lot of the information. We can see the behavior of the tokens in real time. We can see wallet machinations. We can see a lot in real time. Now, we don't know what dev teams are doing, what new software is going to be released and all this, but we have the best chance in the crypto space with the most available information. That's why this is the safest place to be if you do your homework. If you don't, you're absolutely going to get your ass kicked, and you're just going to be handing off your currency units to veterans. And we will take them because that's part of it too. But you want to be in markets where you have the closest kind of available information to something that reflects all known information. And then you will reach a steady state. Right now, the steady state of hypercycle is about $1. Why? Because with the available information, people agree it's worth $1. I think it's worth more. So I'm thinking a few months ahead. I'm thinking to where people merge the tokens. I'm thinking to where tokens go to licenses spit off 1155 tokens, those get pledged, and tokens leave circulation. To me, that's my price for the token. So in my mind, I'm thinking I see a dollar token that's $3. So there's juice, there's fruit on the tree still. Anyway, and I still think that's low hanging, but again, everybody's going to be somewhere along that line. So the ideas form these kind of steady state idea based on available information, and that everybody's doing what's best for them. This is the idea that forms the backbone of our kind of overall thesis. And you can dissect strategies of different investors, whether it's riding the wave of some trendy, meme stocky, bullshitty coin, or the calculated bet of value investing over time, using your 5 T's, looking for projects that can achieve use, utility, and wide-scale adoption, and also realizing that you can't own a million things. There's no point. You want to own enough that you can manage it as a human, or you plus your digital twin. That's probably in the future. Now, that'd be interesting. As an ancillary, maybe I let my twin trade like 10% of my portfolio and let it tell me what to do. Ooh, that'd be cool. I hope that sucker doesn't outperform me. I mean, I guess I hope it does. I don't know. Ugh, it's very tricky. Anyway, let's talk something that's going to come up a lot, and that's short-term profits based on memes and trends. So let's look at this kind of weird domain of short-term profits, particularly those that appear because of memes and meme coins and trends. Did you guys see there was a Simpsons episode last week that crapped all over the NFT market? So what did people do? They launched a bunch of anti-Simpsons NFTs, like whole series of NFTs just to crap back on the Simpsons. Like, things happen so fast. But anyway, in recent years, financial markets have witnessed this new phenomenon, which is the rise and fall of stocks driven mostly by like the Reddit mafia, a bunch of social media blur and buzz and bull crap, mostly through Twitter, if we're being honest, a little bit through TikTok and Instagram, but that's mostly through Twitter, mostly through Elon. And this trend is kind of the embodiment of a game theory concept known as the beauty contest, right? And we talk about this a lot. And this was originally, for those of you that like want to nerd out, this was something that was penned by John Maynard Keynes, Keynesian economics. And basically investors try to predict the stock that other people find attractive, not necessarily with the sound fundamentals. When you're in a beauty contest, it's not about choosing the prettiest contestant, but guessing what the majority believes will be the prettiest contestant. And for a variety of reasons, that might not be the fundamentally prettiest contestant. So the rise of platforms like Reddit and certain groups within Reddit that are very vigilant, and it kind of gave birth to this new class of traders, which are the meme traders, the stonk traders, right? And they rally around stocks. They push valuations to extremes in games that resemble high stakes version of the greater fool theory. It's mostly greater fool theory, where one person profits by selling overvalued stocks to others that are willing to pay a higher price. If you get a bunch of people to punt $3, $4, $10, $100 into a market, you can slowly sell your way out. You build excitement and you use them as your exit liquidity. I mean, that's pretty much the Reddit mafia, 100%. That plus Twitter plus, why do you think Solana is all of a sudden, like just in the last 2 weeks, Solana's become interesting? Bullshit. It's all just pumpy, dumpy marketing PR crap to people that don't know any better. And you can make a market that way, but that is very clearly, game theory wise, greater fool. So from a game theory perspective, meme stock trading, meme token trading is a coordination game, right? That's the actual, like if you look up coordination game, no, it's not criminal. It's not criminal because no one ever goes to jail. Anyway, participants work together to drive up a stock's price. They cooperate, betting on a collective action to sustain the momentum. That's what's happening with Solana. It's cooling off now because at some point you run out of marketing money, right? And also you sell and take profit. It is a delicate balance because each player holds an unspoken kind of understanding among the others that are pushing it that the game succeeds only as long until the music stops, right? Only as long as the collective belief holds. And then, oh yeah, GameStop is a piece of shit. Crap, it's a terrible company. So is Hertz, right? Like, it's so funny. But there's a lot of people that's all they do. I have a friend that this is all he does. He's just meme stock all the time. He refuses to learn about traditional finance. He's like, I'll just do it with meme coins. I'm like, you're going to lose all your money, man. You're just a gambler at the casino. He's like, I've got to make this big hit. I was like, and there's this idea that if you've only been investing a short amount of time, you have to catch up. You don't deserve to catch up. I don't deserve to catch Charlie Munger. They're more than twice my age, 250% my age, something like that. I don't deserve to catch them up. Why? Well, I've only been investing for 10 years. They've been investing for 70. I deserve to catch up. Why? You don't deserve shit. Get rid of the sense of entitlement. If you've been in the market for 3 weeks, you don't deserve to win like someone that's been here 3 years. You don't deserve anything other than what you personally achieve compared to the you that didn't participate. Anyway, you got to keep, there's a lot of cognitive bias that tends to be a part of this meme trade. The whole idea, like I can win quick, I can be rich, I can get everything I want this summer through meme trading, bullshitty tokens and stocks, all this kind of stuff. Anyway, it is a precarious balance because when you do a payoff matrix for this kind of stuff, they change rapidly. The rewards can be staggering for those who sell at the peak, the 3 of them, but devastating for all of the people left holding the bag when the bubble bursts. And invariably, bubbles based on bullshit always burst. So, but what do you you don't care about that. You look at the short-term gain. I'll be one of the ones that get out quick. I'm going to get them gains, short-term gains with a Z. But then there's the risk of just this sudden collapse that you can't exit. I told you, my friend was like in an illiquid asset. He was up like 86 or 89,000 bucks. By the time he could sell, he made 5K. You think, well, that's pretty good. Maybe not if he spent 6 weeks like doing all this mental Olympics and setting up all, anyway, in this context, a Nash equilibrium is fleeting. It's not really achievable because each player's best response in a memey, scammy, musical chairs environment is changing as they interpret market sentiment. So the lack of a stable equilibrium points to the speculative and incredibly unstable nature of meme-driven, trendy investments and investment strategies. Now, you can juxtapose this with the more time-tested, proven strategies of value investing, right? And you observe a huge contrast. The game of value investing is slower, steadier. It takes a little bit more mental work, but it's a lot less stressful. Okay, so when you're looking at, we'll call it long-term value investing, LTVI. That sounds cool. Maybe that's a thing. Anyway, so we're transitioning from the world of memey, stonky, bullshitty, driven sentiment markets. We'll call that the Twitter markets. We find that there is a very methodical arena of value investing, what we endeavor to achieve. So this strategy is akin to a long-term game in chess, where each move is calculated not just for its immediate effect, but for its contribution to a winning position several moves ahead. Some of the greatest chess players play 8 or 9 moves ahead. That's pretty That's pretty incredible if you think about, I'm going to do what's best for me based on what they're going to do what's best for them, which was 9 moves. 9. I cannot do that. I can think like a move ahead in chess. Not so good in chess. These Russian guys I used to play with, we used to beat my ass. I crushed them in checkers, though. Actually, that's a lie. They beat me in checkers as well. Anyway, value investing is predicated on the belief that the market does not always reflect the true value of a company. They see it for X. We see it for X plus some question mark. The value investor, especially in the crypto space, we search for assets that are less than what we believe their intrinsic value is, right? And that value is tricky estimation because at the end of the rainbow there's like equals happiness. So whatever, different people's happiness might mean different things, but we're looking for some measure of intrinsic value that we can use to score different assets against each other until the rest of the market recognizes what we've already recognized and corrects that discrepancy, right? So then they go, oh man, well, it's clearly worth this. Yeah, right. That's kind of like the way I look at hypercycle tokens pre and post token marriage. I see a discrepancy. I think people still don't see it. I think they will. They'll feel stupid. I'll feel richer. Anyway, in this approach, this kind of approach, this value, longer term game theoretical concept approach, it is known as iterated games, iterations, right? So unlike single move games, checkers, where the outcome is decided by one play, iterated games involve a series of interactions that can influence player strategies and outcomes over time. So the value investor's game involves many repeated plays, dollar cost averaging, buying undervalued assets and holding them over many market cycles until your desired exit presents itself, also in iterations. So in a game theoretical approach, value investing entails considering the Nash equilibrium over the long term, right? So in this context, the equilibrium would suggest that eventually the market price will adjust to reflect the true value of a company's assets and earnings potential, the token's potential to reach that wide scale kind of not only availability, but utility. And until then, we are maintaining our iterative strategy, expecting that others will ultimately come to join us in the same realization about what the token's worth actually is. And this could be other things too, real estate and stocks and stuff like that. So another relevant concept is this idea of a payoff matrix. And I've shown you guys these. It's like a little square with some boxes, and it shows the different outcomes of the different strategies. And for value investors, this payoff matrix, it's not +3, -2, +1, -5. It's built over years, right? So the payoff for holding undervalued assets is not immediate. You're not going to see it immediately because it's iterative. This is something that will adjust over time, but it's realized when the rest of the market figures it out, and then they correct these pricing inefficiencies. Does that make sense? So in an approach like this, it demands a lot of discipline and, to an extent, a contrarian mindset, definitely an early adopter mindset. So when a value investor like us, when we move against the tide of popular opinion, which is not unlike being a player in a minority game, a game where the winning strategy is to be in the minority, in investment terms, it often means buying when others are selling and selling things when others are buying, right? Because we're a half cycle ahead of most people, which puts us a half cycle behind in many people's eyes, and that's okay. Can I start over? Yeah, Howard, I'm going to get right to that. So in the value investing game, if you play it correctly, the rewards compound over the years, right? And the cool thing in crypto is not only do you get to be right, but in many of these assets that you can stake, you get to get paid to wait. I think I got paid. Now I was staking Cardano. When I was first buying Cardano, I was buying it for years. I was putting it on BitTrue. I was getting a little bit over 7%, 7.5%, 7.7%. I think I made 170,000-ish tokens just on Bitrue, just waiting for Cardano to make that run. And I didn't sell at the top or anything like that, but I did skim off a fair amount of my staking rewards in the $1 to $2 range. Tokens that I bought for, well, free. Tokens that I bought for free. My average token price, not counting staking, was 2.9 cents. So my average price with staking was negative something. Anyway, so that was pretty cool. So this is a great market where you get paid to wait. I like that idea. So we've kind of talked about the patient strategy, the strategic landscape of value investing. Now we have to compare it directly to short-term, trend-driven, bullshitty, tactics. And so that's going to be, we'll kind of wrap it up on this. So if we look at short-term meme investing with long-term value investing through the lens of game theory, it becomes a very kind of tricky, a little bit nuanced landscape of strategies and payoffs that emerge, because every now and then something that we thought was an investment turns into a trade, right? So sometimes you just have to cut loose and say, listen, this thing that I thought was going to get 10x is not going to. It's up 40%, and I'm willing to take that. So I'm going to take my original investment off the table and let the rest ride on house money. So because you're a long-term investor, because you're an iterative investor, it doesn't mean that you can't just cut ties when the information changes and what you thought was a long-term investment becomes a meme, stonky, bullshitty play, right? So you can draw up the game theory concepts that we've talked about, and you can analyze these different approaches and realize that every now and then, some of your long-term investments are going to turn into short-term investments. And in the same way, some meme, bullshitty projects, some might get through, like they might get to the finish line because they bring on some money, they make some real hires, they pivot, it's not likely, but it could happen, right? So in short-term, meme-driven, investment-y games, we see a phenomenon akin to the Keynesian beauty contest, where the players, the investors' primary goal is to anticipate the market's average opinion. Remember, the average is like 85 IQ. So it's very easy to do. It's probably higher than that. I think that's like a banana has an 85 IQ. It's probably like 100. But anyway, but it's not 110, right? So I think most people read at 8th grade reading level. So that's who you're competing with. 8th graders that watch football and reality TV and don't give a shit about investing. That's who you're investing against. Anyway, it's highly speculative. It's reliant on timing, market sentiment, easy availability, and it can be modeled as a series of very volatile and very transient Nash equilibria. This is the plural of equilibrium, right? Many Nash equilibria that are volatile and transient and not based on a lot of intelligence. And this rapid shift in equilibria reflects this frenetic nature of trends and the potential for very abrupt changes in market dynamics in a very short period of time, right? Because if it's based on, nonsense, then the nonsense changes, the whole thing's over. So the payoff matrix in this kind of scenario is asymmetric and highly variable. So the potential for large gains and larger losses is always like looming. The coordination game aspect with meme investing leads to a form of kind of speculative bubble, which is, of course, unsustainable in the long run, because in any bubble, when it bursts, the game eventually, it just ends or shifts, and the dominant strategy turns from buying to selling. And this is also a scenario that's that passive indexation effect, which maybe we'll talk about Thursday, but that's something that's coming in the stock market that people are not ready for. And like Jerry Hall and I have been talking about this for over a year and a half, but passive indexation is going to obliterate a lot of people in these index funds, and they have no clue. Anyway, it is what it is. That's another story for another day. But essentially, when the game shifts, when it changes, then the dominant strategy turns from buying and holding to immediately selling as fast as possible. And guess what? Not everybody gets to exit at the same time. Turns out it doesn't work that way. So then you look at the other side of it, kind of our camp, value investing in this iterative, repeated interaction process in the market, dollar cost averaging in, dollar cost averaging out, rules-based exits, right? Where our strategy is to buy undervalued assets and wait for the market to recognize their true value. And this can be seen in the form of iterated prisoner's dilemma with the market at large, where cooperation, like holding on to tokens despite market fluctuations, ultimately leads to favorable equilibrium, right? We're at $1-ish in hypercycle. It was 50 cents a couple months ago. It was 5 to 10 cents when it launched. You have been paid to wait. You have been paid a lot to wait. The network hasn't even launched. Doesn't even really launch until compute starts. So it's kind of common sense. Do you think you're going to get paid to wait until the network launches? Do you think you're going to get paid more? Or do you think it's going to be the same? And you start factoring these things and you start looking at what everybody's best payoff is, right? So the Nash equilibrium in value investing is more stable, and it is achieved when the market price finally reflects the intrinsic value of the assets that we've been assuming, right? So the payoff matrix is much more balanced, much more predictable, a lower variance in payoffs, but they compound over time. And the strategy doesn't depend on unpredictable timing, waking up at 2:33 in the morning because some goddamn Twitter post made everybody panic and all this kind of, or somebody gets arrested and all that. No. So when you compare these styles, the comparative analysis reveals a fundamental trade-off. Higher potential right now payoffs, right now, of the short-term trend-based investing, where you know only a tiny amount of individuals ever actually win, and the other 99.9% get obliterated, versus the more modest, steady, consistent returns of value investing over time with lower risk, greater predictability, and you get paid to wait. And so instead of a quick 2x, you can have a slightly slower 10x or 20x or 50 or 100x. I've had 5 or 6 100x assets. 100. It doesn't take, people are like, how'd you make your money? I mean, I had 600x assets, bro. You don't have to do it. That's it. You're done, right? I just want more because I'm a material girl and it's a material world. Anyway, real world events like GameStop. You remember the GameStop gamma squeeze? It wasn't quite a short squeeze, but it kind of turned out to be. In 2021, if you guys have seen that movie, Dumb Money, it's pretty funny. But it exemplifies that these game theoretical principles come into play. They're like very obvious. And meme investors, they believe that they don't need to educate themselves because they're due. It's like they're immediately due, and they're entitled. And it doesn't, just not just because people are younger. It's not, doesn't, because you're young doesn't mean you're like, this is a mindset of a lot of people, old, young, it doesn't matter, right? It's a mindset. I'm due, I'm owed, I'm entitled to win. Everybody else has been here for 12 years, but I've been here 13 seconds. I deserve. You don't deserve shit, but what you go and earn. You deserve what you work for. Meme investors coordinated massive buy-in, disrupting the typical Nash equilibrium system, and they cause this massive short squeeze, which is what happened. If you tell people to buy something that's crap and enough people agree, they buy the thing that's crap. The people that were shorting the crappy thing, they get beat up because they have to cover their shorts, because shorts, there's no ceiling. It's infinity. That's what you can lose when you short the wrong way. You can lose infinity. So at some point, they have to buy back the assets that they borrowed to sell, that they thought were going to zero because it's a crappy company. Is it any better of a company? No, it's still a crappy company. Has anything changed? No. It's just that there's more bankrupted people. That's all. More people have punted their ill-gotten gains from 2021, their stimmies and their other crap money. They punted into a market that they didn't understand, and they lost it. Great. And 6 people made money. Good for those 6 people. Everybody else got gutted. And this is just a classic case of like, this is the GameStop case of like speculative coordination, highly risky, based on market sentiment rather than any kind of fundamental value. So YOLO, bro. And you know, this is where we're at. So you have to decide where you want to be. in along that kind of, it's not one or the other, right? Like we're all, it's like a scale, right? You're memey and bullshitty and tradey, or your long-term investment, completely fundamental. We're all somewhere on that scale. You got to figure out where you guys are. And yeah, those 6 people lost all that money. No one, I don't think anybody actually won, except maybe the one dude that was having the TV show, the YouTube show. Everybody else got their ass kicked. Almost everybody lost. There was a few people, thankfully, a few people got to the sidelines and like paid off some student loans and stuff, but almost everybody lost. I mean, percentage wise, you could say like the winners were a rounding error, but yeah. All right. Stay in school. Don't do drugs. Oh, that's a great finish. Time and patience, game theory, applied cognitive bias, and good analysis, and Adderall. Maybe. Do we have nodes, hypercycle nodes? Of course. Of course. We are the registered hypercycle node licensed seller. You go to Nodemarket. I'll show you. You go to Nodemarket. Click here. Oh, wait, not that one. Let's go to Nodemarket, just nodemarket.io, the main page. When you go here, you'll see buy node license. Click on it, and you can get whatever you want. We have 2, 8, 16, 32, 64, 128, 256, 512. That's master license, master node license. That's 512. So yeah, very easy, very simple. Yep. Okay. This was a long one, but you know, sometimes you gotta roll up your sleeves, bro. Gotta get some schoolwork in. All right. And on that note, stay in school. Don't do drugs. Don't do anything. My poor insolvent drunk, strung out on meth grandmother would not do. Be safe. Go slow. Don't rush anything. Don't get caught up in the meme, hypey, bullshitty stuff. Stay off of Twitter, X, or whatever they're calling it. Don't get any kind of financial advice on a platform that's predicated on theft, graft, corruption, social crap, and just like the worst parts of humanity. Just don't. Just do the work. And just remember that none of us deserve anything. You go out and get it. You don't deserve it. We have to get it. Once you do the work, you deserve everything you got. But if you've been here 13 seconds, don't think that you deserve anything. Do the work. It's okay.
Are you tired of all the uneducated noise you're getting from the droves of YOLO meme coin peddling douchebag gurus out there trying to use you as their exit liquidity? Would you rather learn a competent university level set of skills that will guide you in managing and investing for the rest of your life? Join us 3 days a week at Digital Investor. Develop your knowledge of game theory, cognitive bias, macroeconomics, monetary theory, investment theory, psychology of the crowds, and more. For more info on Digital Investor and how it can help you, reach out at nickblacknext.com.